Welcome to today's deep dive. Our mission for you today is unpacking a massive uh, $2 trillion financial shift.
Yeah, the explosion of private credit. And our goal is to cover all points clearly and, well, keep it simple.
Right. Okay, let's unpack this. Simply put, private credit is just non-bank corporate lending that basically skyrocketed in the U.S. after banks tightened their rules post-2008.
Exactly. And to get the full picture, we're going to trace why this massive U.S. market is suddenly showing some real stress fractures. And then look at why India's emerging market is, playing a fundamentally different and safer game.
Oh, okay, so to understand the global picture, we really first have to look at why the U.S. boom is cracking under pressure. Like, imagine taking out an adjustable rate mortgage on a giant mansion.
Right. At first, interest rates are near zero, and it feels like free money.
Exactly. But then, almost overnight, rates skyrocket and your monthly payment just triples. Scale that panic up to a multi-million-dollar corporation, and that is what's happening right now.
Yeah, it really is. The vast majority of these corporate loans are floating rate. So these highly leveraged businesses are suddenly drowning in debt service costs.
And looking at the data, like 25 to 40% of this U.S. credit is tied directly to software companies. So couldn't the current AI disruption absolutely crush these highly leveraged borrowers?
Oh, absolutely. Morgan Stanley actually sees that exact collision coming. They're expecting an 8% default rate as AI pressure just eats into software margins.
Wow, 8%. That's huge.
It is. But what's fascinating here is that the real systemic risk isn't just at the borrower level, it's actually at the fund level, with this massive liquidity mismatch.
Right. So it's essentially a modern bank run, but instead of a bank not having cash in the vault, these giant funds just physically cannot sell their underlying corporate loans fast enough to pay off the withdrawing investors.
That's the crux of it. Funds from giants like BlackRock, Blackstone, and Morgan Stanley, they structured these as open-ended funds to attract retail capital. They promised periodic withdrawals.
But the catch is those underlying assets are fundamentally illiquid, right?
Exactly. They are long-term, highly illiquid private loans. So when investors get spooked, the cash is just trapped. BlackRock recently faced $1.2 billion in withdrawal requests and had to cap payouts at just 5%.
Wow. So you ask for your money and they just say, well, sorry, you can't have it.
Pretty much.
Mm.
Still, at less than 1% of global securities, this isn't a 2007 subprime crisis. It's just a really severe stress test.
Right. Well, here's where it gets really interesting. If the U.S. structure is causing this liquidity panic, how does the developing market avoid the exact same trap? Let's look at India.
Yeah, India's private credit is tiny right now, just 0.6% of GDP, and it doesn't steal market share from traditional banks. It mostly funds specific gaps, like real physical asset creation.
But I have to ask, is India really playing a safer game, or is it just because their market is in its infancy and they haven't had the chance to over-leverage yet?
It's a fair question. But if we connect this to the bigger picture, India's regulatory safeguards are the true hero here. It's not just about size.
Oh, really? How so?
Well, the ecosystem relies entirely on closed-ended funds, meaning they don't promise easy withdrawals to retail investors like the U.S. funds do.
Oh, I see. So they lock the capital in to match the actual lifespan of the loan itself.
Exactly. And they restrict these funds exclusively to sophisticated investors. Plus, they're legally prohibited from taking on long-term leverage. They literally eliminated the exact liquidity mismatch that is plaguing the U.S.
Okay, so what does this all mean for you listening? Simply put, U.S. private credit is testing its limits due to structural flaws, while India is positioned for safe growth.
Right. And this raises an important question for you to consider. If financial safety relies entirely on the fund structure rather than the asset itself, what other alternative investments in your portfolio might be hiding a liquidity mismatch?
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.